Chris from eBroker, thank you for joining me today to talk about finance. I've known you for a few years. You've been referred from a number of clients and they've been very happy with what you do. Appreciate you making the time.
Thanks, Peter.
Chris, the first thing I want to ask you is about pre-approvals. Would you recommend that a buyer who comes and sees a broker looks to get a pre-approval in place?
Yeah, absolutely. A pre-approval is essentially a full application, but you've not found a property yet. So the credit checks are done, the income assessment's done, the lender has assessed your whole situation and has issued a pre-approval that they're willing to give you a loan of X amount, subject to finding a suitable property. So you're pretty much 90% of the way there in terms of getting your finance. All you need to do at that point is find a property, get it valued, and provided there's nothing wrong with the valuation or the property, then it proceeds to full approval. So the advantage with that is that you know exactly how much you can lend, you know that everything's been assessed, you'll be a lot more confident when you're talking to the agents. As you know, as an agent, you get a gut feeling talking to people. And then of course, the fact that you've got the actual pre-approval letter, if it's requested by the agent, gives you the evidence.
Well, that's a great question because yes, as agents, we do want the pre-approval. It gives us confidence to talk to our sellers, but we're aware that some pre-approvals can be self-assessed online. What are your thoughts on those?
They're relatively useless because it's a lot more complex than just doing an online calculator when you're assessing people's income and just general situation. It doesn't take into account typical credit scoring. If there's variations in your income, if you've got uncertain income like overtime, allowances, things like that, it doesn't really take into account the bank's credit policy. So they're relatively useless, and if you go on them, they tend to be all over the place. They'll have quite different results. And so, yeah, you do need to get a proper assessment done.
We agree, totally. Okay.
Yes.
There's a lot of people in this market are saying to us that they really would like to buy something before they sell, and obviously there's a finance gap between things. How have you helped people in this market, which is pretty tight for stock, help when they need to buy before they sell? What are some strategies available to people?
Yeah, as you know, trying to do a subject to sale can be quite challenging. You tend to be at the bottom of the pecking order. So there's two ways you can go about purchasing a property before you sell yours. In both cases, you do need equity in your property. So the first one, and if I can highlight it just with some basic figures, let's just assume that you're purchasing a property of the same value as yours. You can borrow using equity in that property to fund the deposit on the new purchase. So assuming you've got a 60% loan against your place, you could get an extra 20% loan, which takes it up to 80%. And then the money you get from that 20% facility can fund your deposit along with a new 80% loan, and you've basically funded 100% of the purchase price. You actually need a little bit more than that because there's stamp duty and things too, but just keeping the math simple for the purpose of the conversation. And then you can sell your property in your own time. Now that is subject to borrowing capacity because the bank does need to see that you can service the peak debt of everything together. They can factor in proposed rent on your property too, which can help, but still it does require sufficient borrowing capacity. If the borrowing capacity is not there, you can look at bridging finance, which is very, very similar. You use the equity again, you can't go over 80% on the peak debt scenario, but they look at the borrowing capacity based on the final position.
Okay.
So with the bridging finance, you then have typically 6 to 12 months to sell your property. So there is a bit of a time frame on it, and there's a risk that you could buy in a higher market and sell in a lower market. There are risks to it. And bridging finance is a little bit more expensive in the bridging period, maybe just an extra percent, not crazy.
What about setup costs? The differences between the two scenarios for setting up the loan?
There's no actual differences in terms of application fees. It's just the bridging loan has a higher percentage rate typically. What I've found is in most cases, just to elaborate on this a bit further, is it's a good idea because obviously to try and buy and sell in the same market. So if you get your property ready for listing, you speak to an agent, you get your photos done, you're ready to pretty much launch it. When you do find a property and successfully purchase it via a bridging offer, then you can put yours on the market very quickly. And in most cases, I find the bridging period might only last a week or a month or a couple of months. It's quite short. And it gives you just time to move, etc.
I think it's good advice. I find a lot of people a bit nervous about doing the bridging in case they don't get the value of sale that they were expecting from the house.
Yeah.
Some people are a bit reluctant to do it, but it's actually good to know that it's possible and not that difficult as long as you've got equity in your house.
Absolutely. The more equity, the better. And the banks do factor in safety buffers in case the sale price is a bit lower than expected.
Got it.
But yeah, I've done quite a few, and generally they've become quite well.
Good to know. Okay. How long does it take to get the formal finance approval once an offer's been accepted?
If you've got pre-approval, it can often just be about a week. It depends on how quick the valuation's done, but very, very quick. You know, if you're actually starting from scratch and you've got to go through the lodgement to the pre-approval, then it could be a couple of weeks. It depends on the banks. They've all got different assessment timeframes, but that'd be the average.
My experience has been 28 days for people who are employees and a bit longer for people in trusts and complex situations. What are your thoughts on time? Is that a safe buffer, 28 days for finance approval?
Yeah, 28 days is quite commonplace and is a very safe buffer. I mean, because you need to allow time to, it depends where you are in the process. If you've only just started talking to the broker and you're still finalising the options and gathering data, you need to allow time for that. Yeah, if you're pretty much ready to go, then you can perhaps offer a shorter finance time frame, and that's another advantage of pre-approvals. It might make your offer more appealing if you put down a 14-day finance clause too. So it really depends where you're at in the process.
One of the things we do as agents is we ring a broker like yourself, Chris, and just simply ask a question based on your professional opinion. Is the buyer likely to get finance, green, yellow or red?
Yes.
And I believe you're pretty happy to answer those questions because you've done all the pre-approval work.
Absolutely, and I always encourage potential buyers to let the agent know to call me, and I can instill some confidence that I'm confident it's going to go through.
And that certainly helps us put the deal forward to the seller as well.
Yes.
Now, how much money do people need to have as a deposit so they're not impacted by LMI insurance or loan insurance with regard to their borrowings?
Yes, so the golden rule is a 20% deposit and 80% loan. There are some lenders who you can do it with a 15% deposit. Typically the rate will be a bit higher. You'll pay a little bit of a premium, but yeah.
Okay, well, so it's not too bad, and I know the medical profession can go up to 90%, is that true?
Yes, there's health practitioners like physios, chiros, there's lawyers, accountants, vets, even banking staff can go to 90% without paying lender's mortgage insurance, and they get the same rates as if it's an 80% loan, which is really good. Medical practitioners, doctors, also dentists, specialists, they can even go up to 95%.
Okay.
And again, the same rules apply. It's discounted rates. So yeah, and because they're very safe professions, they're regarded as low risk. So the bank's happy to take on that risk and not take out mortgage insurance.
If someone comes and sees you, what do you suggest they bring to them so you can assess what they can borrow?
It varies how it works, but a lot of the time it's a conversation over the phone to start with nowadays, and I might get driver's licenses, pay slips, tax returns, depending if they're PAYG or self-employed, an understanding of their assets and liabilities, and I can just do the initial credit checks and the serviceability assessment, check out bank's credit policies, and just give some indicative options from there. So it can be quite, rather than get everything straight away, we just have an initial conversation and get a ballpark idea. And then once we're ready to go from there, we may meet up to discuss it further. Then we collect all the extra information which is required.
So it sounds like that maybe the initial meeting is on the telephone. You can just talk to people.
It's much easier just to go back and forth, have a bit of a chat and just provide some general guidelines to start with. It's usually, 10-minute conversation.
Yeah, good to know.
Yeah.
In terms of fees that a broker will charge, does it typically all come from the institution? How are finance brokers and mortgage brokers paid?
Yeah, so some brokers do charge an actual fee. I personally don't. And then all brokers will get paid a commission from the lender. So that's an upfront commission that's paid usually around a month after the loan settles, and then you get a trail commission each month after that. Really, the bank's just paying you instead of paying their local branch staff to organise everything and submit the loan. The loan, whether it comes through a broker or a branch, goes to the same credit assessment team. Branches don't assess things there. So yeah, essentially that's the payment model, and the idea is that I'm your banker, your contact person to help you with any loan restructures, any questions moving forward.
Awesome. Okay.